Hello, dividend growth stock investors. Colby, the DGI Crab, here coming at you July 20th, 2025, here on a Sunday morning. We're going to take a look at the stocks that this channel emphasizes and see where the value in the markets going into the week lie. Going to do this type of video every single Sunday. For those of you who have been around for a while, thank you so much. I've really been excited to see the subscriber count and the watch time growing quite a bit. Definitely gives me a lot of motivation to continue to put out content for you all. I have accepted a new job, and I had to do some certifications and some different things like that over the last week and a half. So I've been pretty preoccupied with those types of things, but I've got a few different videos that I've just about gotten ready to film and get out there to you that I think you're really going to like coming up here this week when life kind of slows down a little bit. But dividend growth investing is all about consistency, and I'm always going to bring you this Sunday morning video to go over our values. And my portfolio this week is looking to be rated PG. That's right, Procter and Gamble just might be right in my crosshairs for the upcoming investing week. Now, I'm not a licensed professional financial advisor. The content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own, and you should always perform your own due diligence prior to investing your hard-earned money. And my allocation strategy, you guys, is as follows. I will always put half of my new invested money each week into age-appropriate ETFs for automatic diversification. And then I start looking at stocks that are yielding 30% or more above their 4-year average yield to start identifying those values. And then I do have my personal list of top 10 favorite stocks. And I'll tell you what, guys, at times I will just add those even if the value isn't amazing. Procter and Gamble just happens to be one of those 10 stocks for me. Now, I do break these stocks down into different age tiers where you've got the low yield, high growth stuff for the younger investors in tier 1, and the high yield, slow, stable growth in tier 4 for the older investors, 54 and up, and then everybody in between. I really try to remain in a tier that I think is age appropriate for myself, and I will buy more ETFs in any given week if for whatever reason I just don't want to add anything in my stockpile, so to speak, for any particular given week. So with that being said, we'll hop over into the spreadsheet where I have my stock sorted by the valuation tab. This is where I'm comparing the 4-year average yield that I update every single weekend. Comparing that to the current day yield to see how much of a value we've got. And if it's stuff that's in the green, we've at least hit that 30% threshold. For tier 1 investors, the 30 and under crowd, we're looking for stuff that's not super high yield. You're probably going to be yielding to start out 1 to 2% with everything that you're buying for the most part. But you're looking to get the year over year dividend growth to be 10% or better. So you've got a lot of time in the market, and those 10% increases, the more and more of them you get, the longer that you're in the market, really starts to snowball your passive income very, very quickly. So United Health is going to remain the story here until they recover. United Health was hovering around in the low 300s, and then toward the end of the week this past week, crashed even more down into the low 280s. I had a little bit of money sitting on the side on Friday that I was kind of keeping to the side for Procter and Gamble. Used some of my money that I had set aside for Procter and Gamble on Friday, but I also continued to add a little more into UNH. 4-year average yield 1.42%, current day yield 3.13%, which means, you guys, because that's based on your dividend per share, that's right, UNH was within just the last 12 months was up above $600 per share, now sitting down here at $282. Looks super cheap to me right now, especially in this category. You're buying and holding for the long term. So even if it takes a little while for UNH to recover, you just assume that they will here within the next year, 2 years, 3 years, whatever it is. And then when they do, they get back to business as usual with really high dividend increases year over year. Your starting yield up around 3% or better, that's going to start compounding really quickly. So that's the name of the game here, you guys. Nike and Nordson still look like good deals. The 4-year average yields continue to slowly climb with these guys, but I'm still buying both of them, especially if I'm 30 or younger. Tier 2, the 31 to 41-year-old investors. A little bit higher starting yield in this group of stocks. You're looking anywhere from like 2 to 4%, depending on what you're buying when you're buying it. You want a high single digit annual year over year dividend growth rate. 7 to 9% is usually about the range we're looking at collectively with these stocks. Target and Hershey, the only two buyable stocks for me in this category right now. They've been down both for quite a while right now, but I am going to say that they're both really solid deals. I think Hershey's yield will grow faster and more consistently over the next few years than Target's probably will, but a couple of very safe dividend yields, quite a bit higher than what they historically have been over the last 4 years. Union Pacific and McDonald's, I'll continue to keep my eye on. A couple other stocks that are in my personal top 10 favorites. Union Pacific is getting to the point where it's creeping up into the point where I might want to consider buying UNP. Only 11% higher starting yield than the 4-year average, but if it is one of my top 10 favorite stocks, it's one that if it gets a little closer to maybe 15%, then I'm going to have to really start to think about putting a little money off to the side to maybe swoop in and add a little bit more of my UNP position in addition to Procter & Gamble. So for the tier 4 investors, age 42 to 53, starting yield keeps getting a little bit higher the older that you go. The dividend growth rate year over year gets a little bit lower. But this group of stocks here is sort of meant to really start pushing you toward being able to retire early off of dividends. Hopefully you've gotten to the point where you've got a lot of stuff in the tiers 1 and 2. You're getting a lot of big dividend increases with positions that you've built up over the long haul. And then when you hit that age 42 up to 53, you're really trying to hammer better starting yield, but continue to get stuff that's going to grow year over year. Pepsi, one of my top 10 favorites, another one. That one has just been legitimately undervalued for a while. The yield had gotten up above 4% in recent weeks. It's recovered a little bit, but I'm still not taking the pedal off the gas here, you guys, so to speak, because I'm very happy to get Pepsi. Definitely down below $150 a share. I'll probably be adding it even beyond $150. Very excited that I got my Pepsi position built up more this year. ADM and Hormel, these guys have been down for quite a while right now. Still look like fine enough deals for me. Yields in the high 3% on both of them. 4-year average yields in the higher 2% range. So definitely these look like juicy places to start positions or to keep adding into those positions. GPC has been down in the buy zone, then it recovers, then it drops down into the buy zone again. This is one that maybe if you're doing limit orders, you might set something at a very particular price for GPC, so that way you might be able to pick up a position without having to constantly monitor it. I don't typically do limit orders, but for something like GPC or back here in tier 2, for example, McCormick and American States Water, NextEra, these have all just sort of been tipping into buy zone briefly and then zipping back out again. So limit orders are something that you can consider looking at doing if you want to just make sure you grab a share of a stock at a certain price, or maybe even a bunch of shares if you've got enough money going in there to purchase a lot of them. And then Procter & Gamble here, you guys, I'm adding to Procter & Gamble because I just don't necessarily need to wait for it to get remarkably cheap. We're yielding 12.7% higher here than the 4-year average yield for Procter & Gamble, 2.42% compared to 2.73. May not seem like a lot, but again, for me, because it's a top 10 favorite, I'm going to go ahead and add the Procter & Gamble right now while it looks reasonably priced, certainly. Procter & Gamble, if we just take a little side trip over here for a moment, and take a look at price per share. Over the past year, it's down 8%. Over the last 5 years, it is up 23.4%, but you can see it is tailing off here right now at a 52-week low, or close to a 52-week low, that it achieved earlier this week. Over the past 10 years, it's up 93%. So Procter & Gamble over the long haul does go up from a price per share perspective pretty consistently. And then on the dividend side, there's a reason it is a common favorite among dividend growth stock investors, you guys. Yielded the high 2%, 5-year growth rate at about 6%. Not a bad combo factor there when you're looking at buying something for in the high twos. You hope to get a 6% or better growth rate on it. But that share price is also extremely consistent. The payout ratio is positioned beautifully for them to continue to comfortably grow that dividend. They did a dividend increase for the year already earlier this year in the 5% range, 68 consecutive years of growing that dividend. So just one of those stocks that you could really sleep well at night knowing that you own them. And I'll jump in and grab something like this that's of this high quality if it just looks like it's trading at a little bit of a deal. And guys, remember, if you were around here a couple of months ago, I was saying the same thing about Microsoft when we had that kind of brief tech sell-off a few months ago. Microsoft was down below $400 a share, and at that point in time, it was yielding just a little bit higher than the 4-year average yield. Not even, it might have gotten as high as 10% higher, but it certainly didn't get into 15 or even 20%. I went ahead and trickled money into that position and was pretty adamant that I thought a lot of people ought to be taking a look at doing the same. And I mean, look at the share price now. It jumped from like 375 all the way up to 310. Glad that you have that position there in the 375 range at that point, right? Because, again, you want to get this stuff when it's on sale because you're buying the amount of dividends per share that you're getting it at. So you want to get as many shares as possible for as little money as possible. That's the name of the game. Tier 4, age 54 and older investors. This group of stocks, you guys, good high yields, good stable growth rate. Once again, nothing in this group looks to be undervalued. The high yield stuff has just continued to be so popular. Now, for the rest of this, I've got a little separate tab here. This is my top 10 favorite stocks. They're all stocks located somewhere between 1, 2, and 3. So I just put them here on a separate tab so I can keep extra close eye on them. Pepsi, Procter & Gamble were ads for me this week, and then J&J and Union Pacific, and even McDonald's right now, all yielding above their 4-year average. Not quite at the point I want them at just yet, but definitely getting close as far as I'm concerned. I want to have big, comfortable positions in all 10 of these. These are buy and hold forever type of businesses, and I think they're great additions almost regardless of your age and time horizon. All right, so this is how I'd be allocating money for the upcoming week based on these prices. If I'm in tier 1, I'm doing my 50% into ETFs. It's split into S&P 500, small cap, dividend growth, and international. Tier 2, same 4, different allocation. Tier 3, SCHD, VYM, DHS. I love all of these, especially for that 42 to 53-year-old investor. And then tier 4, lots of different things, high yield stocks, high yield bonds, preferred shares, MLPs, real estate, Bitcoin income, 3 covered call strategy ETFs, Stevo, JEPQ, and SPY, my favorite trio of covered call ETFs that are out there. And then this would kind of be how I'd prioritize those single stocks. For the tier 1s, UNH, Pepsi, Nike are my high priority ads. Nordson, Target, Procter & Gamble, lower priority ads, but still at good value. In tier 2, Pepsi, Target, Hershey, UNH, probably the ones I'm going to start with first in that tier. Nike and Procter & Gamble certainly deserve some attention there. Also, tier 3, Pepsi, ADM, Hormel, Target, PG, UNH, Nike could be a nice collection of stocks to buy there for a lot of diversification and still getting a lot of growth. And I'd even be looking at continuing to add to Pepsi in that 54 and older category. They're yielding right at about 4%. Good enough for me. That's another episode of Undervalued Stocks, you guys. Keep on investing.